2025 is the year of IPOs, to the extent that every few days a major company announces an initial public offering. And in many cases, subscriptions fill within hours. Look at LG Electronics India Limited. 6.5 hours, that's all it took for the $1.3 billion IPO to get fully sold on October 7. This was the fastest in 17 years among major Indian IPOs. Valuations stretch into billions of dollars, and behind it all is a quiet revolution. The rise of domestic capital, the financialisation of household savings, and a newly confident class of investors transforming how India raises money. This isn't just another IPO cycle. It's a structural shift where Indian investors are now the backbone of Indian listings. According to multiple market data providers and investment banks, 2025 is on course to be the biggest IPO year in India's history. Some critics also say that India's IPO boom is built on inflated valuations, hype, and behavioral bias. What does that mean? We'll look at that too. In this edition of Everybody's Business, we'll discuss the forces driving this phenomenon, the names leading the charge, the numbers behind the frenzy, and the risks that could test its strength. Let's first start with the scale. Between October 1, 2024 and October 24, 2025, a staggering 288 companies filed draft prospectuses with the Securities and Exchange Board of India, or SEBI, together seeking to raise around 4.8 lakh crore rupees according to Prime database. Of these, 174 IPOs received SEBI approval for around 2.7 lakh crore rupees, and 111 issues have already hit the market, collectively mobilizing a record 2.18 lakh crore rupees in just 1 year. To put that in perspective, between October 2023 and September 2024, only 85 IPOs raised about 86,000 crore rupees according to an ET report. In just 12 months, the number of IPOs has grown by roughly 30% and the capital raised has more than doubled. Foreign and domestic analysts agree about one thing, that India has become one of the world's busiest IPO markets. According to data published by Bloomberg, by proceeds, 2025 has already placed India fourth globally, behind only the US, Hong Kong, and China. This year's momentum follows a 2024 record when IPOs had already mobilized 1.6 lakh crore rupees, the highest ever. By October 2025, the country is on track to break that record by a long shot. Hitendra Dave, CEO of HSBC India, recently said that 2025 promises to be the largest IPO year of all time for India. He said that the next 2 months will be very busy. And it's not just the number of listings. The size of deals has expanded dramatically. According to K. Balasubramaniam, head of Citi India, the country saw only about $5 billion IPOs in the last decade. Between January and October this year alone, there are about 10 such billion-dollar deals either completed or in progress. He said that this indicates something very important, that growing financialization of savings is happening in the country. Now, let's look at the players driving the boom. Some of the headline IPOs include Hyundai Motor India, which raised 27,859 crore rupees in October 2024, the largest issue in India's history. Tata Capital Limited, the country's biggest listing of 2025 so far, raised 15,500 crore rupees. HDB Financial Services and Swiggy were both in the billion-dollar range. LG Electronics India's IPO was subscribed in just 6.5 hours with 11,600 crore rupees, and Lenskart Solutions, expected to raise around 2,150 crore rupees, had an overall valuation of about 70,000 crore rupees. And Grow, the Bangalore-based online brokerage, is planning a 1,060 crore rupee fresh issue plus secondary sales, also targeting a valuation of about 70,000 crore rupees. Also in the pipeline are names such as Reliance Jio Infocom, Flipkart India, PhonePe, SBI Funds Management, Manipal Hospitals, and Avarda Electro, many of which are expected to go public within the next year or two. And in all of this, domestic investors are dominating. Data compiled by Prime database and cited by Bloomberg shows that domestic institutions, Mainly mutual funds and insurance companies are behind most of the demand. Mutual funds alone have invested about 22,750 crore rupees into IPOs till October 2025, roughly 19% of all IPO funding so far this year. Get this, domestic institutional investors' ownership in more than 2,000 companies listed on the National Stock Exchange has risen for 5 straight quarters to 19.2% as of June, the highest level in 25 years. Holdings of foreign portfolio investors have dropped to 17.3%, the lowest in more than a decade. Foreign portfolio investors have sharply increased their anchor participation but not their overall share. Anchor participation refers to the portion of an IPO that's reserved for anchor investors, which is large, reputable institutional buyers such as mutual funds, sovereign funds, or insurance companies who are allotted shares a day before the issue opens to the public. By the way, now that we are talking about this, let's quickly talk about the major steps in an IPO process. We all know that an IPO is the process by which a privately held company offers its shares to the public for the first time on a stock exchange. It allows the company to raise capital from investors, expand ownership, and gain liquidity. The IPO process is regulated by the SEBI and follows a defined sequence. A company's board first approves the plan to go public and appoints managers, legal advisors, auditors, and others to manage the issue. After due diligence, a draft red herring prospectus or DRHP is prepared. And what is that? A DRHP is a preliminary document filed with the SEBI that gives detailed information on the company's business, financials, risks, and intended fund use, allowing regulators and investors to review and raise queries before final approval. Once the DRHP is filled with SEBI and the stock exchanges, the regulator may seek clarifications before issuing an observation letter, allowing the company to proceed. The company and bankers then promote the IPO to institutional and retail investors through roadshows and advertising. Just to be clear, a roadshow in this case is a series of presentations by a company's management and investment bankers to potential investors. The IPO then opens for subscription, investors bid within a specified price band, and the final issue price is determined based on demand. Next, the shares are allotted, refunds issued, and the company lists on stock exchanges, resulting in the start of trading. Now, what are the key days in an IPO? Once an IPO is announced, first, anchor investor allotment happens one working day before the issue opens. We've already discussed who anchor investors are. Then comes the public subscription period, usually lasting 3 working days, during which retail, institutional, and non-institutional investors place bids. After the issue closes, the basis of allotment, deciding how many shares each investor receives, is finalized within about 6 days. Refunds and credit of shares to demat accounts follow immediately after. Finally, on listing day, the company's shares debut on exchanges for public trading. Now, in India's booming IPO scene, retail investors are increasingly prominent. SIP inflows into mutual funds are hovering around 30,000 crore rupees a month. Small ticket SIPs of less than 500 rupees per month, mostly from tier 3 and tier 4 towns, have doubled in count since 2022. And all of this has made domestic liquidity the key driver of IPO success. And to illustrate this success, let's take a case study. Let's talk about LG Electronics India Limited. We've already discussed how its IPO was fully subscribed in 6.5 hours. That made it the fastest major Indian IPO to be fully booked since Reliance Power's 2008 mega issue, which sold out in under a minute. Local investors accounted for roughly 60% of the bids. On debut, LG shares surged 48%, underlining both the intensity of demand and investors' confidence in large consumer manufacturing plays. The success also reflects a new trend noted by experts, that more and more multinational subsidiaries are choosing to list in India. Now, let's look at another IPO that is the talk of the town right now. The Lenskart IPO stands out as a defining moment in India's 2025 listing boom. It's a test of how far investors are willing to stretch valuations for consumer tech stories. Founded in 2010 by Piyush Bansal, Lenskart disrupted India's eyewear market by combining technology with affordability, offering online try-ons, home eye tests, and a multi-channel model that now spans over 2,100 stores, more than twice that of Titan Eye Plus. In FY25, it reported 6,653 crore rupees in revenue and 975 crore rupees in operating profit. The company's proposed 70,000 crore rupee valuation underscores investor faith in scalable, digital-first consumer platforms. Analysts note that the IPO could reset how markets view India's retail tech hybrids. But skeptics warn of deja vu, that Lenskart's premium pricing, like earlier new age IPOs, risks outpacing the fundamentals. The listing will ultimately reveal whether India's capital markets can distinguish genuine innovation from expensive optimism. Remember Paytm's post listing crash? It reminded the markets that brand visibility and digital buzz can't indefinitely substitute proven and sustainable profitability. The Meesho IPO, which is expected in late 2025, also marks a key test for India's e-commerce startups after the Paytm and Nykaa eras. Backed by SoftBank and Fidelity, Meesho has built a massive social commerce platform enabling small sellers to reach customers via WhatsApp and Facebook. With over 150 million users and improving profitability, its listing, reportedly targeting a $5 to $6 billion valuation, will also gauge investor appetite for a new age, asset light digital marketplace focused on affordability and tier 2 consumers. And another case is Grow, part of the fintech brokerage space long dominated by Zerodha and Angel One. Grow's IPO, set for public subscription from November 4 to 7, comes with a price band of 95 rupees to 100 rupees per share, and its targeted valuation is around 70,400 crore rupees. And its listing will also be a test of whether India's post Paytm, post Zomato era of new age IPOs can combine growth with sustainable profits. Such a diverse group of issuers is a striking feature of the latest IPO rush that stands out in comparison with the 2021 boom. In 2021, the IPO boom was dominated by tech startups such as food delivery platform Zomato, Paytm, and Nykaa. So, what are the big IPOs expected in the next year or two? Reliance Jio, National Stock Exchange, and Walmart backed Flipkart are among the closely watched offerings. Some other large ones include Walmart backed PhonePe, Hindustan Coca Cola Beverages, SBI Funds Management, and Manipal Hospitals. Now, did the 2025 IPO boom appear overnight? Not really. It is the result of deeper long term shifts in how Indians save and invest. And this is what we meant by financialisation of savings. This term, which is used repeatedly by analysts, means that more household savings are being channeled into financial assets like equities and mutual funds rather than physical assets such as gold or property. After the COVID pandemic, millions of Indians opened trading accounts, began investing in SIPs, and started viewing equity as a legitimate long term asset class. And in all of this, technology has been another game changer. The adoption of UPI for IPO applications has been a huge boost. Regions like Bihar and Uttar Pradesh, where the penetration was previously very low, are participating more now, all thanks to the ease of the process. Essentially, people from tier 2 and tier 3 towns are applying to IPOs using their mobile phones. Digital platforms have shortened timelines, simplified payments, and removed friction. And not just that, India's regulatory and infrastructure upgrades have also played a big part. Listing timelines have been cut from several days to just 1 or 2. Refunds and allotments are almost instantaneous, and this efficiency encourages small investors to keep participating. If we look at a decade ago, India's markets were heavily dependent on foreign portfolio investors. But as per Prime database data, Indian investors now account for roughly 75% of IPO investments in years where total proceeds exceed 1 lakh crore rupees. Local investors have pumped nearly 979 billion rupees into IPOs since 2024, compared with around 790 billion rupees from foreign funds, according to Bloomberg. and experts say that this pool of money can form the core of demand for years and years to come. But the change is not just from the side of the investors. A subtle but very important shift is also underway among companies themselves. Many family owned businesses that once resisted the idea of public listing are now embracing it. Second and third generation leaders are more open to a professional and more organized operation and are engaging with retail investors for the long term. More than 300 companies have listed since early 2024, and domestic investors are now so central that even heavy foreign outflows from secondary markets haven't slowed the primary market. In 2025, foreign portfolio investors withdrew around $16 billion from Indian equities, the second highest outflow on record. And yet, the benchmark Nifty 50 index still didn't take a very big hit, powered by domestic inflows. So, what is the catch here? What is the reality check? Not everything is exuberant. While the market is hot right now, returns are cooling. According to Bloomberg analysis, the median 1 month return for Indian IPOs has fallen to 2.9% in 2025 compared with 22% in 2024 and 25% in 2023. About 40% of mainboard IPOs now trade below their issue price a month after listing. Some marquee names, such as National Securities Depository Limited, have performed strongly, rising nearly 60% in their first month. But others, like Glottis Limited and BMW Ventures Limited, are down more than 35 to 40% from their offer price. And this is where pricing discipline comes in. There are also concerns about smaller speculative IPOs. Oversubscription rates in micro-cap issues often exceed 100 times, raising fears of overenthusiasm among retail investors who are chasing quick gains. SEBI has been monitoring these trends and recently tightened disclosure and lock-in norms for high-risk categories to improve investor protection. Another factor to watch is how companies use the capital that they raise. Studies show that in many recent issues, only a portion of the proceeds has gone into new capacity or expansion. There's another angle to this. In an opinion piece in moneycontrol.com, Shankar Sharma argues that India's IPO valuations are often engineered through anchoring bias. Basically, companies first go public at unrealistically high prices so that later, even after crashing 70 to 80%, their shares appear cheap. Using Paytm, Nykaa, Zomato, and others as examples, the author says that investors were lured by hype around tech and brand visibility, not fundamentals. When these stocks inevitably collapsed, the inflated IPO price itself became the anchor, making the new, still lofty valuations look like bargains. This, he writes, is the real IPO pricing game now. Sell irrational exuberance first, then sell supposed rationality later. In essence, he says that IPOs are deliberately overpriced to exploit behavioral psychology. Prices so high that even steep losses feel like opportunity rather than overvaluation. So, what's missing from the story that we have talked about so far? It's how regulators and the financial system are responding to this IPO frenzy. In recent months, both SEBI and the RBI have quietly acknowledged that while India's IPO surge is a sign of economic depth, it also carries risks of excess. In its October 2025 bulletin, the RBI pointed out that the rush of new listings has been fueled by easy domestic liquidity and record household inflows into equities. But it cautioned that such liquidity driven booms can quickly cool if credit conditions tighten or foreign inflows dry up. SEBI, meanwhile, has been reshaping the IPO rulebook to make the system sturdier. It has shortened the listing timeline to just 3 days, expanded the anchor investor pool to include long term players, and increased lock in periods to discourage quick flips by large institutions. It has also tightened disclosure norms, requiring clearer justification of valuations and risk factors, especially for loss making or startup style issuers. Beyond that, SEBI has restricted mutual funds from pre IPO private placements to prevent conflicts of interest and excessive hype. When we take a step back, we realize that India's IPO boom is not just about sky high valuations and a flood of new listings. It's about whether our markets are ready for listings that stay listed with companies that have good governance, clear business models, and genuine long term value. Right now, the data tells us something interesting. Only about 1 in 3 of these new age IPOs are delivering meaningful outperformance for investors. The story doesn't end here. If India's IPO story in 2025 has been about exuberance, the next chapter will be about endurance and accountability. Whether companies, bankers, and investors can convert speculative enthusiasm into genuine long term capital formation. And we'll keep bringing you that story at The Print.